Welcome back to the channel, everyone. Today I want to talk about the Kilted Trader's updated divorced put due diligence and how he's now discovered that there's been over 14.5 billion sham failed to deliver resets. Also, I want to talk about the incoming market crash. So stay tuned and let's make some money. But first, with all these recent outages and financial institutions having online banking difficulty, maybe now is a good time to invest your money in a more decentralized way. My personal favorite platform for investing in cryptocurrency is BlockFi. Not only can you buy some Bitcoin, but you can also earn interest on all of your deposits, just like you would with a regular high-interest savings account. You can also take out loans using cryptocurrency as collateral, just like you'd be able to with a regular bank, with fairly low interest rates from as low as 4.5%. And you can also get a BlockFi Rewards Visa Signature credit card to get cash back on all of your purchases. I think it's an introductory offer of 3% for 2 months cash back, and then 1.5% cash back from then on. You can find my BlockFi sign-up link down in the description below to either sign up for a credit card or for an investing account. But now I want to dive straight in with the key information. So, Biden says in the days ahead, people may see their retirement account values sink and interest rates go up. Therefore, it seems that even Joe Biden is predicting a market crash or at least a heavy market correction, saying that in the coming days, people will see their retirement account values sink. And on top of this, from Bloomberg, China have apparently stepped up efforts to ring-fence Evergrande, not to save it. And there it is. Beijing has no interest in bailing out Evergrande. And people can't say they weren't warned. China has been telegraphing this for months. The real question is, how does Beijing not bailing out Evergrande affect the property sector? A big question for commodity exporters. And I personally think China not bailing out Evergrande is going to have a massive impact on the Chinese property sector, but also the Chinese financial sector as well. Because I don't think the issue is going to be localized to just Evergrande. As an example, Fantasia also didn't make payments due on their 2021 notes. And for those of you playing at home, Fantasia is another one of China's largest property developers. Certainly not Evergrande's tier, but certainly up there. And therefore, Evergrande isn't just a one-off rare occurrence. In fact, quite the opposite. Most of China's large property developers can't afford to make their interest payments. And therefore, it's going to topple the entire Chinese property market. Not just Evergrande, but probably most of the big developers. And that's going to have a massive knock-on effect onto the Chinese financial sector and also the US, UK and Europe's financial sectors as well. Don't forget, of all countries, China has probably been the best country to invest in over the last 20 years. And therefore, the US, the UK and Europe and Australia and everywhere else in the world is going to have massive exposure to Chinese debt and also Chinese equity. But obviously I've spoken about that more previously in some of my other videos. So in this video, let's talk about something different. Now I also want to move on to talk about the potential volatility squeeze, the too long didn't read Twitter thread. So volatility is a financial product, complete with an ever-growing chain of derivatives and structured products. Each stage magnifies leverage and exposure. There's also indirect connections that amplify these movements as well, such as dealer hedging, risk parity funds, and more. And therefore, volatility is also subject to short squeezes, given its unlimited inverse downside. Structured products and derivatives can amplify these moves further. The first volatility squeeze occurred on Volmageddon. Short volume products were wiped in a day. After declining for 16 months after the pandemic crash, volatility has been rising since early July, and realised volatility has also increased as well. As you can see, the VIX has been trending downwards for months on end since April of 2020, but since around July of 2021, the VIX has been rising again. Volatility is negatively correlated with price. When volatility spikes, equity price declines. Therefore, owning equities is effectively taking short volatility exposure. Below is UVXY, a leveraged long volatility ETF compared to the S&P 500. And obviously this is an inverse ETF. We know the S&P 500 has been moving up significantly after it crashed in March of 2020. But obviously, because this is an inverse, we saw a massive spike in March of 2020 and then a slow decline. When volatility is squeezed, markets rapidly decline. This is the likely cause of every sell-off since 2018, including the pandemic crash. Below you see the increasing volumes in a leveraged long volatility product, UVXY, precede the three major drawdowns since 2018. As you can see, in each instance the volatility is falling and then gets squeezed upwards, volatility falls again, squeezed upwards, volatility falls again and is squeezed upwards. Looking at volume over a long period is somewhat misleading in this chart here, since the price of the product has gone down and therefore the same dollars invested or traded results in higher volumes. But this also highlights a very key point. As the price of volatility declines, the same dollars can buy more long volume exposure. Unless volatility is crushed below its July lows, a serious volatility squeeze is likely in the near term. This would result in a significant and rapid drawdown in the market. The drawdown may be attributed to macro events, of which there are plenty to choose from at the moment. As an investor, you must recognise that equities are at high risk given their correlation with volatility. Not investment advice, but to prepare yourself for this squeeze, either be on the sidelines or the right side of the squeeze. And therefore, because of the large amount of catalysts out there at the moment, like the debt ceiling, the Evergrande problem, and many others as well, like these financial institutions having problems themselves, the volatility on the VIX is likely to get squeezed and spike upwards again, causing a massive drawdown or crash in the stock market. And another one of those catalysts is the soaring gas prices. The world's top commodity trading houses are being told by brokers and exchanges to deposit hundreds of millions of dollars in extra funds to cover their exposure to soaring gas prices. 7 sources with direct knowledge of the matter told Reuters. And therefore, it's not just problems in the US and problems in China, but it's also problems in the UK that's causing financial institutions to be required to deposit more cash collateral. Now, I also wanted to give an update on Mac Attack, or the Kilted Traders divorced puts due diligence. If you wanted to read further, I'll link this down in the description below, and I'll also link his YouTube down there as well. Too long, didn't read. The divorce from reality due diligence is being expanded. This preliminary showing tells us that we can increase GameStop's fail to deliver resets or short interest transfer by up to 6 billion potential transfers, and AMC can increase up to 14.5 billion potential fail to deliver resets or transfers. Hello Motos, this is an update to show you some of the preliminary results from me asking for some help from programmers. They're helping me automate the pulling of data and organising of the basic analysis. We're still a bit away from the ultimate version of this due diligence, draft title Claymore, but I'd like to share some results we've found so far. So he starts by explaining divorced puts, and I've explained this on the channel many times before, but as a quick kind of synopsis, it's a way to hide true short interest in the option chain. So basically, instead of just holding a short position, you buy deep in the money calls and also deep in the money puts. You then exercise those calls to get some shares, use those shares to cover your short position. The market maker obviously won't be able to locate those shares and therefore has to create them and has to create some synthetic shares to give to you. Therefore, you had a short position, you've covered it with synthetic shares, and you still have the deep in the money puts, and there's been those additional synthetic shares created. And therefore your short position or your naked short position doesn't increase the fail to deliver reset timer because you've effectively transferred that naked short to the market maker, who can then transfer it around again, and you've still got your deep in the money puts, which is basically an option version of a short position. And this doesn't necessarily mean that there's 14.5 billion synthetic shares, because obviously, as you can see from the above, when puts expire, the fail to deliver aspect doesn't disappear and that share is still owned. And therefore, of these 14.5 billion fail to deliver resets, some of them are going to have expired or been reset again and again. Therefore, it doesn't mean there's 14.5 billion synthetic shares out there at the moment. But what it does mean is that there's a hell of a lot of fail to deliver resets and a hell of a lot of synthetics that are being reset. And therefore, because the Kilted Trader is now automating his data analysis, he can now use a broader population with a more specific set of instructions or requirements for it to be a fail to deliver reset. He's now checking every date, on every strike, on every chain, looking for evidence of divorced puts. To be classed as evidence of a divorced put, it has to meet one of the following criteria: a parity value of 3,000 put contracts or above, a parity value 5 times the average parity value for the day, a parity value 5 times the average value for that strike. And in all cases, the parity value must be above 100 for the strike or day. Because the pulling of data is now automatic, it's also removed potential manual data entry errors. So in this table, you can see the 8 tickers that were set to PCO only on January 28th, and also 4 control tickers for comparison. For this, I used the parity of 3,000 contracts to give me the shares that are guaranteed to be divorced puts, and then I used the parity of 100 contracts to 2,999 contracts as potential divorced puts as well. As the controls, he's got AAL, which has 238% of the float as divorced puts, SoFi, which has 229% of the float as divorced puts, DPZ, which has 29.7% of the float as divorced puts, and Lyft with